James Watson of MFS Investments. You're head of investment strategy. There's a lot of discussions in the markets right now about the Fed. Will it change the monetary policy in autumn? What's your opinion on that?
We don't see the Central Bank of the U.S., the Fed, changing policy at all by autumn, even this year, even into next year. And here's why. We read all the statements of the head of the central bank, Ben Bernanke, and he shows no interest of reversing policy at this point. And the reason for that is he believes he's failed in his job. His job has two descriptions: price stability and job growth. He feels the job growth part he hasn't succeeded at. The U.S. 7% unemployment rate, he believes it should be at 6.5%. At the current growth rate, we can't get there in a year, and he stated this. So I don't believe you will see any major Fed policy change this year, 2013, into early 2014.
So, but it's a fact that we have a lot of Fed policymakers that speak in public the pros and cons of the current monetary policy. Why do we hear so many different opinions right now?
We do hear many different opinions, and there are some governors on the Fed. Some have a vote on the Open Market Committee, some don't. But the overall thing that everyone should understand about the U.S. Central Bank is that the chairman of the Fed has exorbitant power and has much more power than any of the others. It's not a democracy. It's not truly a voting system. He has disproportionate influence over monetary policy. And we believe if he leaves in February, which could happen, his successor will be even more liberal. It's likely to be Mrs. Janet Yellen.
Do you think he will leave next year?
We think because of what he's told some reporters, he's thinking about it. We don't know that he will do this. It's up to him. But he believes he's accomplished several of his goals, not all of them, particularly the jobs one. But he's said in private that he's thinking about doing something else.
So in other words, stock market corrections, which we see right now, the uncertainty in the markets is it's just a zero event. So the markets could further rise.
Right. The markets, particularly the stock market, had a little bit of a sell-off, but basically it's back to normal. Markets in general, particularly in the U.S., follow cash flow and earnings. And they're still rising in the U.S. U.S. corporations are doing really well in this environment. As long as the market knows the Fed is going to support them if there's another slowdown, then they're going to still invest in stocks. There just isn't enough yield in the bond market or in the cash markets.
So until year-end 2013, how much of a potential has the S&P 500 or the Dow Jones in percentage terms?
In percentage terms, we think it will follow earnings. And earnings can grow, and the estimates that we're getting roughly 6 to 7%. So, and we think the market is not overvalued from a price earnings point of view. So it can still just follow earnings without multiple expansion in probably that growth range.
So this policy, monetary policy of several central banks worldwide, it's a lot of money in the markets. How much of danger do you see inflation-wise in 2 or 3 years?
Well, it should create inflation, but creating money doesn't in itself create inflation. You have to see that money go into the banking system and get relent. In the United States, still the biggest economy in the world, I'm not focusing on the United States, but we should look at the United States because typically their cycles end in recession, and typically that occurs when the central bank is raising rates and everyone is borrowing. It hasn't happened yet. Companies are still deleveraging on a debt-to-equity point of view. Consumers' net worth is rising. That means they're still deleveraging. So we don't have a credit cycle in the U.S. yet. And so the Fed doesn't have the ability really to raise rates and stop a credit cycle. There are no big bubbles in the United States yet. Maybe we'll see them.
So let's have a look at Europe, where the central bank is also very progressive. Has Europe or the Eurozone the worst behind itself?
I think it is. Number one, the ECB has done a lot of really innovative programs, particularly the ESM and the LTRO, in buying in debt. Number two, the central driving force behind the ECB has to be the German taxpayer and the German government. And they continue to want to hold the 17 member nations together in one currency. And they do not want to have bank failures or have one of these countries default. So I think their incentives, particularly with Germany being a 50% export-driven economy, it's in their interest to keep this together. And the spread markets tell us the world believes that Europe will hold together, and we believe it will.
Last question. You manage a portfolio at MFS. Can you tell us how it is, what assets and percentage terms are in that portfolio?
Sure. In its neutral position, it has to be 60% fixed income and 40% stocks. But right now, I'm overweight stocks, particularly U.S. stocks. I like U.S. stocks. In fixed income, I'm not enthusiastic about any of my choices, but I'm overweight emerging market debt, underweight U.S. Treasuries, and deeply underweight U.S. high-yield corporates because I don't like the risk return there.
What about stocks in the portfolio? Which ones did you overweight?
Technology interests me a lot. Technology has very great earnings potential, high cash flow, no debt, international sales, 3 product revolutions, and it trades at a lower forward price earnings ratio than the rest of the market and has a lower beta than the market.
Mrs. Swanson, thank you for the time.
Thanks for having me.